The clearly massive equity sell-off that we saw last quarter and particularly in December, high yield spreads did gap up as well significantly. How much did they gap up relative to what you would have expected with that equity market pullback?
You know, when you get equity market pullbacks of 20%, give or take, you often see high yield spreads gap up to 800, 900 basis points to treasuries. This time around, they went from about 300 odd basis points to 540 basis points. So the sell-off, this sell-off, the Q4 sell-off, was much more centered around equities than debt, particularly high-yield debt.
Is that encouraging for the fundamental outlook for the economy? What factors can you draw from that?
I wouldn't draw too much into it. Because, you know, look, in a lot of ways in the course, since Christmas, the markets have retraced 40% of their losses. Mm-hmm. So we are living in more fragile markets, which are extremely volatile. So I think drawing big themes from something like this, I just wouldn't go quite that far.
When just before Christmas, there was a lot of debate about the level of liquidity in the markets following a statement from the Treasury Secretary. What's your view on the broad level of liquidity, particularly in some of the distress levels that you focus on?
It is abysmal. Right. So, you know, can I just step back for a moment, right? If you look at high yield, you've gone to a market now where 25% of it is daily liquidity. So 25% of junk bonds are set up where you can redeem out of them daily. At the same time, the trading desks which make markets in this stuff, their capital is a fraction of what it used to be 10 years ago. So when you look at kind of where we are, the markets are just much more fragile. Modest moves in redemptions and otherwise, particularly in credit markets. Look, in equity markets, you've got trend following, you've got quant funds. In high yield markets, in distressed markets, you've got this fundamental liquidity mismatch, which is now just going to make stuff just so much more choppier going forward.
So people talk a lot about leveraged loan market at the moment. Yeah. Is that a genuine area of fear that we should be more focused on? The spreads went from 316 to 538, right? In high yield, in leveraged loans over the course of Q4. That's sort of breathing in a way, right? Your average high yield spread over 15, 20 years is 500 basis points. And yet you say the liquidity is abysmal. So there's a gap here in your rhetoric. What am I missing then that explains why we don't need to be that worried?
Yeah, you know, the things too, worrying about kind of monthly moves, weekly moves, overstates it, overdoes it. I would expect just to have much more choppier monthly moves, quarterly moves, but the fundamental underpinnings of it, which are demonstrated by 538 basis points, I wouldn't just overreact to that.